Real Estate for Breakfast, where McGuireWoods partner Phil Coover brings you essential conversations with leaders in commercial real estate, translating complex industry challenges into actionable insights.
Good morning. This is the Real Estate for Breakfast podcast. I am your host, Phil Coover, a partner in McGuireWoods Real Estate Group in the Chicago office. Today, I have a good friend, Matt Katsaros from Wildwood Investments. Matt, thanks for coming on the show.
Thanks for having me.
Second time in the show, two-timer club. Matt was with us when he was talking about national development when he was with a former company years ago, CA. And so he's back talking about his own company, Wildwood Investments, that you started in 2020.
Yeah, it was a pandemic-based decision, partially. Sitting in my home office on Wildwood Avenue, looking at a street sign. So that's the beginning of it. But let me know if you want me to dig in right away or...
Yeah, I like to just get right to it, especially my podcast. So many podcasts, there's so much filler at the start. I want to let you jump right in. I was thinking today, you started just 5 years ago. You've seen a lot of markets since, 2020. There's been a lot of ups and downs. So tell us about your decision to leave the kind of corporate institutional world of development and become an entrepreneur and start out.
I was working for, like you said, a national scale developer, looking at 7 or 8 different markets, spending a lot of time on the road. Super interesting work, but super dominating of your time. Younger kids at the time who were quickly getting older and playing sports. And so while I loved working there, it led to an opportunity with being grounded from flying due to COVID, being home and reflecting on what's important. And also kind of tracking the middle market Chicago space while working at a large firm. I never got away from it. I wasn't doing it, but I had a lot of friends in that world and seeing the success they were having, building $10 to $50 million projects versus, $100 to $250 million projects really interested me. So when the pandemic hit, I made some calls, probably picked up the phone to 30 or 40 different folks, but had a couple in mind that were in the space already. That would be a good complement to what I thought I could do. And landed with my partner, Mike, who is a general contractor and developer, but had a little bit less of the experience in finance and deal structuring and joint ventures and stuff like that. So that's how we kind of put our heads together. He kind of on a day when I had nothing to do for work, I hadn't quite left the company yet. And I think we got our first deal under contract in like 45 days. So
that's awesome.
It kind of happened quickly and it's worked really well since.
Do you think that looking at and developing in other markets help you learn a few things that you could bring back to your hometown?
Yeah, I think the complaints that some people have about Chicago, one being taxes, others being construction costs, supply and demand usually isn't a complaint, but at times it can get there. But you see other markets that there's some stuff kind of out of whack, whether it's real estate taxes are higher than ours, whether it's certainly there's markets with hard costs that are way higher than ours. Soft costs can be a lot higher than ours depending on environmental impact and stuff like that. So you kind of realize that underwriting in Chicago is, I think, a bit easier than a lot of other markets, especially when you're local and you know the players. You can kind of quantify risk a little bit easier. So coming back, it was nice to have this deep subcontractor pool, deep broker relationships, good political relationships as far as folks that can help you with zoning and vote on your zoning for that matter. Whereas other markets, it's just harder to quantify some of that. So it gave me a lot of confidence that Chicago, while it could be volatile with what we had crime issues and some other fiscal issues we still have, it was not overly challenging to underwrite deals to a confidence level that I had for that rather than being outside of the state.
And what type of deals are you working on? I know you've got some mixed use projects, but multifamily primarily?
Primarily multifamily. We try to stay away from retail. We've had some success with it, just being on really good corners. But generally 90 to 95% of the building will be multifamily. We target between 30 units and 100 units. Some of that is zoning. Some of that is the ability to raise debt and equity. Some of that is sourcing sites. I think there's a lot of very large deals that are entitled here in Chicago. Half of them are in the West Loop and Fulton. Half are everywhere else. We really targeted the neighborhoods where we feel like we have a little bit more of a competitive advantage over high-rise.
Right. And so you've had a lot of success in what I think of as the premier neighborhoods in Chicago, up near Wrigleyville and Lincoln Park and kind of getting close to West Town. What's your favorite area?
Mine is Lakeview. I was always a 3200 block guy. I think I've lived in 5 addresses that were within a block of 3200 before I moved up to my home where I live now. My partner's a Lincoln Park owner, lives in Lincoln Park. So I would say those two are pretty neck and neck. We've had a lot of success in those neighborhoods. And then, of course, Fulton Market, and then kind of bleeding north into River West, where we have our largest project now. we love as well. Just that area is much more competitive in the sense that there is a lot more potential supply.
Right. Yeah. You're getting closer to the loop, a lot more supply down there. So do you want to tell us about kind of your project in River West?
Yeah, so we've completed 4, the 3 in Lakeview, the 1 in Lincoln Park. Those were about 50 unit project. And then we stepped up a bit into a 99 unit building at Grand and Aberdeen, calling it Aberdeen Crossing. It's right where Grand and Aberdeen connect, where Aberdeen dead ends. So you're about a block or 2 north of the Trammell Crow campus, where they've got the life science project and residential, and then obviously just south of that is Fulton Market. So love the location, bought it from a repeat seller, and it was a buy right deal. So that obviously underwriting something with not having to do 20% affordable. With the tax incentive now, that can work, but it still is generally more attractive to have buy right. So yeah, it's 99 units, a mix of the smallest are studios, the largest are 3 bedrooms. We've got a bit of retail. And people know it as the flag site because it's got the giant 200 and something foot flag that flies over the Kennedy. So that was an interesting entitlement piece and also design piece, but we figured it out. And we should be topping that building off in about 3 to 4 weeks.
Yeah, it's super cool. So a lot of people will recognize this site by that flag as you're driving down the highway. And I like that you called it a buy right deal. So you mean from an entitlement perspective, you can develop multifamily by right?
Correct. Yeah, it had zoning that was approved, I believe it was 2009 for a condo project. There was some nuance to the zoning that we had to kind of get some small sort of variances approved, but the underlying zoning was a -5. And that density and height and FAR and MLA got us really to where we needed to be. So it wasn't like the easiest site to get like designed and approved, but we didn't have to do a zoning change, which would have triggered the affordable.
Great area. I'm going to the Pizza Michi. It was like
Yeah.
a block away. Super hard to get into, but I got a buddy who's got a reservation for tomorrow. So I'm excited to check that out. I'm not going to starve myself all day. How close is that? Pretty close to the Bally's casino that they're building?
Yeah, it's kind of around the corner from Halstead. I mean, Halstead's 800, we're 1100, so it's a few blocks west.
Yeah.
But it's going to be in that same general corridor where you look at kind of traffic and foot traffic and retail and stuff like that.
So tell us kind of about your background. Like, because you say we build in 50 units, 99 units. Those are big buildings. Those are huge projects. It's like, how did you get to this step where you're able to break out on your own? Because most folks can't just come out of nowhere, start up their own shop and just be putting up 50 unit buildings. So like you had this very long track record and career that brought you to the point where you were able to lift off like that.
Yeah, I mean, I started out of college for a brief stint in commercial lending and then went into commercial brokerage. And that's where I kind of learned how to buy and sell or, really sell, but represent both sides of the deal and understand underwriting to some level of, confidence. But I really got to work with a lot of developers. That was back in the condo conversion era of pre-09. So I worked with a lot of developers, but they were mostly doing conversions, a little bit of land. And then decided to transition to Pangea Properties when I sold some notes to the founder there. And that really taught me REIT structure, which I don't utilize today, but it was really more of a learning the business side of real estate as well as the deal side and how to grow a company and manage people and work with people.
Yeah.
Because as a broker, you're kind of on your own, generally speaking. So that was really fun, learned a ton. And then when the buying ability of that distressed era didn't dry up, but we weren't buying at a huge clip at that point. I got an offer to come over to CA Ventures and do the institutional development stuff, which was really different for me. And it is interesting because it puts it in perspective when I say we were working on 300 and 400 unit deals, 50 seems small.
Yeah.
But you're right, for 50 is not small. Luckily, my partner had done a handful of projects in the 20, 30 unit range, which isn't all that dissimilar to a 50 unit. It's a little bit different, but same height or same type of construction. And so that gave me the confidence to kind of jump in to answer your question. And we were kind of able to just grow the business. It wasn't necessarily having to start from scratch, and that was important.
I love the tag team of you and Mike as your partner. You've got like a nice vertical structure there because he can handle the GC work. He's been buildings in Chicago for decades. He's an architect by trade, right?
Architect by schooling.
Okay.
Never fully practiced, but understands plans and how to draw and all that good stuff.
Yeah, so that's super helpful just to have that capability in-house without having to get a quick look at things.
Yeah, I can do an 8-sheet Excel workbook, and he could do an 8-number back of the napkin underwriting, and we're usually kind of ending up at the same spot.
Right.
But the Excel workbook allows you to raise money and work with more lenders, and the institutional underwriting is kind of what you need
Yeah.
to capitalize deals these days. But we had done enough that as long as we land on the same return on cost generally, who cares how you get there? He's done enough of them,
Right.
but we always end up in the same spot and laugh about that.
Yes. There's two things that I want to talk about that may or may not be challenges in the market, but there's the capital raise, capital stack side. And then I also want to hit on, and we could tackle whichever one you want to first, but also just how are supplies doing right now? I think we're recording this, I should say, mid-April, April 22nd, I think it is. So I put a date on that. I learned during the pandemic, you got a date when you're recording, because if you release something a month later, things can dramatically change. But, the tariffs are a large talk, and I'm not going to ask you to look into your crystal ball in the future, because I think there's a lot of people out there trying to predict what's going to happen, and no one really knows.
Mm-hmm.
Well, I'm curious what you're seeing from just like hard cost side. Is anyone raising their prices already? Has anything changed as you sit here today to a couple months ago from like kind of the supplies and hard cost side?
Yeah, so there's a few questions in there. I think from the capital market side, I think what you started with, which is all that plays into that, right? Is the availability of capital. I think the banks in our world, and I call it middle market, are ready to do deals. I think that there was a lot of banks that didn't do a whole lot last year. There was only a handful of projects really starting, and I think they really like the thesis that we've proven out of kind of the neighborhood space. And there's some larger developers kind of jumping into that space as well. The institutional stuff just isn't happening right now. So you'll see some bigger name developers doing sub 100 unit deals, partially just because the economics are better and then there's capital for it. So that's kind of the capital side of it. We've done all of our raising of capital through what people refer to as friends and family. For us, it's really friends and real estate people. It's almost all Chicago-based investors because they really understand the nuance of the corner and the thesis of the deal. You go outside of Chicago, even on a retail level like our fundraising is, it's very challenging. So local capital markets as far as debt and equity. And we really have syndicated every deal. It's very common to have pref equity now. So we have our first piece of pref equity in our grand deal because it was such a large equity raise for us.
Yeah.
But we did that actually internally with our current investors who just liked the terms that we were seeing in the market, which is always nice to have a little more relationship with your provider. So that's good. So we've kept it pretty simple, sort of 90-10 deals, like most do, and that LPGP structure. And then as far as supply and demand, talk about the size of the deals. CBRE and Newmark and JLL and all those firms generally didn't report on supply really under 100 units. So we were getting left off the supply reports.
Yeah.
So it always makes you feel a little bit like, they missed you. Well, now we're like on them, which goes to show how little supply there is.
Yeah.
So I think the last one I saw was 600 units delivering in 26, and we were 99 of them. So that's real market share. We're really there. Yeah, and
it's being delivered. That's huge.
It's kind of cool. I know it's obviously not good for the city because we should be delivering 6,000 units for the size of city that we are.
Yeah, you and I have talked about this many times over the years. Like there used to be that crane watch.
Right.
There was 40-some cranes up in Chicago. I mean, I remember working in Prudential Plaza where we recorded our last podcast 6 or 7 years ago. And you could just see cranes like from the windows. And now we look out. Here we are at 77 West Wacker. We got one. Might actually be yours. It's kind of like in the right area. But
that's probably the casino or right next to it, right down the street.
Right.
But we're just behind it. We were the fourth residential crane, is my understanding, in Chicago. Related ShapeHack and CMK having the other three. So those are some pretty big guys to put your name next to. So 600 units, clearly that's going to be great for rents. Again, not great for tenants. It's going to get expensive. We've seen some really probably 10% rent growth over the last year. Now that's not going to sustain at that level, but we're probably going to see 3 to 4% for the near future. So people are underwriting rent growth now. The banks still don't love seeing it, but it's really there. We're turning up units in our first 4 projects, and we're getting 4% very easily in those new construction buildings. So that's good for a developer and owner. Beyond that, it's hard to tell. I think there's something like 19,000 units entitled in Chicago. About 9,000 of those are West Loop market. The rest are everywhere else combined.
Yeah.
So again, you kind of know where people are looking to get deals done. I don't know how many are capitalized. You could guess, maybe a handful out of those building projects.
Right.
So it's hard to tell. But I would say the next couple of years, you're maybe 1,000 a year.
Yeah, I have heard a few other players getting in the market. Like you were saying, that more and more folks are kind of focused on this neighborhood development, but they're been at it for years. I feel like they're just starting to dip their toes in.
Yeah, there
Take
is
some time.
there is more. There's probably 5 or 6 between 30 and 150 units that are going right now, and there's probably 5 or 6 more that'll start this year in the neighborhoods.
Yeah.
So you're talking a few hundred, maybe 600, 500, 600, and those are not making those supply reports, right? Generally they cut those off at like 50 to.
Right.
So yeah, you're right. There's some more stuff kicking around in the neighborhoods, but only certain neighborhoods really have the, I guess they call it YIMBYism, right? There's still a lot of places that's really hard to get anything done here. So there's other neighborhoods that the rents would support more development, which is obviously the solution to like naturally affordable housing, but you can't get anything done. I actually had coffee with someone this morning on the city council, and we talked a lot about that, is how do you get other neighborhoods who could support development to get some development going? It's kind of siloed into like 6 different areas. Plenty of other places that you could get $3 rents or whatever you need to get a building to work.
Right.
But you can't get zoning. That's the other restriction to supply. It's a long answer to your question.
No, it's super interesting. And also on the alderman side, I mean, you've got some that are more supportive than others, I'm sure, in terms of just getting things approved. I know you've had some success in Lakeview and in those areas, like with having that kind of support. So I was the capital raising side. I was imagining that it's challenging at times to try to pass the hat and raise the equity portion of the capital stack, which is why, as you mentioned, you've seen some more preferred equity come into the picture in the past few years. But on the other hand, stock market's up and down.
Right.
Yeah, I was thinking about alternative investments on my way in this morning, and I was talking to a different developer the other day who is returning 20% IRR to some of their limited investors. That developer was kind of happy to have a profit, but they're like, oh, we're kind of hoping for more on this particular project. But I was like, hey, like I'm looking at my portfolio and it's down quite a bit over the last year from my 401k because the market's in the tubes. I'm sure a lot of folks are happy just to have a positive return when things are going the other direction. There's sort of this chaos or uncertainty in the market. But how's been raising the capital stack for you?
Yeah, it's a good question. We haven't raised money since the closing of our grand project. So that was late last year. So we haven't really been out there since what's going on in the last, 60 days or whatever it's been, since it got really hectic and chaotic in the markets. But certainly, when people can make 4% in savings accounts and, 20% of the market, it was challenging. I think we were getting people that wanted specifically alternative investments. They knew they needed more than just to be in the market.
Yeah.
But there's a lot of people that don't do that. They just keep their money in their retirement. So, of course, if it's in a 401k, it's probably really not liquid anyways. But, there's certain people that just set it in there and forget about it. So I'm really excited to get back out there. We have a couple offers out, one on this site in Lakeview project, and then one where we were one of, I think, 13 offers on a office adaptive reuse project. I think we're in the final 3, but we're not really sure where we'll shake out there. But if we get those, we'll be back in the market. And I'm excited to be there because, we're getting the tailwinds of rent growth and limited supply. And we needed something to get Chicago kind of stimulated from an investment standpoint.
Yep.
The negatives of crime, taxes, and fiscal issues are not gone, but I think the crime narrative is now we're really dealing with taxes and being broke,
right?
Which is tough because that just leads to more taxes.
Yeah.
So if I had to point to anything about fundraising, it's how do you get over the conversation around how do you peg your taxes? And I think most real estate folks would agree that that's like the toughest thing to answer. And we say underwrite 17 to 18% of gross income. We have extremely high gross income in our buildings. We're very high rent buildings. So we're kind of saying like, that's where it should be. If it goes higher, you review it, get through the board review, and you hope to correct it. If it's lower, it's a benefit, which we've seen. And so you have to just kind of go with that kind of an answer. And the rest of it, I think, is actually faring pretty positively for Chicago right now because a lot of the other markets nationally are getting hurt by oversupply.
Yeah, interesting. I have heard about that. Like down in the Southeast, there's been so much development there.
Right.
There's just so much supply. And Chicago is always chugging along.
Yeah.
It's got tons of businesses here, so many colleges that just feed young, talented people into the city every year. I've always been bullish on Chicago, and it does feel more optimistic here than it did 2-4 years ago.
Yeah.
In a lot of different ways. Mentioned office adaptive reuse. That's been a popular term here in Chicago. I don't know if it is nationally or not. We've certainly seen a lot of state, local government funded, supported. Have you gotten into that at all? Or
we haven't gotten into the big stuff like LaSalle Street reimagined or anything like that. We're not quite that size scale developer. So we haven't really dipped into those types of funds or high tech or TIF or even historic tax credit. I mean, there's all sorts of different types of buckets of capital that could go into an adaptive reuse project. We tried to do 202 and 220 South State, which is a very famous deal because that's where the federal judges blocked the development.
Okay.
They wanted a courthouse, or a federal, I should say, plaza in front of the courthouse, not two buildings. But that was with my old firm. So we did work on it. I've worked on projects like that, but never to completion. We like to keep it a little more simple, for lack of a better term. You know, the less movement in the capital stack, for us at least, the better.
Yeah.
It's awesome if you know how to do it and make it work. We're not financial engineering guys, so we kind of like it to work.
Right.
And if you can make it better, good.
Yeah.
But I mean, we're just not like, we've not done the historic tax credit route. So the ones we've looked at have just been low basis, well laid out apartment projects. And of course, if they work on their own merit, then we would try to layer in some credits as well.
Yeah. Well, also, your original thesis is really staying in the neighborhoods.
Right.
There isn't a lot of
There's not a lot of
unused office just sitting around the neighborhoods. It's down in here in the Loop and the West Loop and
Right.
North.
Right.
Let's talk about the hard costs. Have you seen steel, anything else, just raising in costs quite yet? Or
You know, it's too early to tell. Our windows come from our Mexico manufactured. So when we bought out that contract, probably 90 days ago, we put in a tariff provision that we would split the tariff overage with the supplier, which they did. So we hedged it a little bit. I know we're still going to get a hit with maybe a $75,000, $100,000, whatever it is, change order, but at least it's half of what it could have been. So that was some good forward thinking, but we're going to see more. We just don't know yet what it is. You know, our buildings, again, are huge. Stuff coming from, we don't order cabinets from China. And some folks definitely supply most of their stuff from overseas when they're buying in huge numbers. But most of our cabinets are from Wisconsin. I mean, most of our stuff's local. So we should be okay.
Right.
Knock out.
Yeah.
Knock out. Yeah. Our building's topping out soon. So concrete hasn't really been affected, or I would know. Steel's that hasn't really been affected. I would know, stuff like that.
so that's how it comes to you. You place an order for windows for a big project, and then there's a change order that says, hey, cost of windows just went up. Here's your tariff bill.
Pretty much. And we've got change orders for other reasons too, but that's the first one directly correlated to a tariff. And yeah, like I said, we'll see more, but I think we're far enough along that I think we bought out most of that stuff prior to. And so I'm not sure how that'll be affected if it actually does hit it, back to a certain price.
Right.
And I haven't done this long enough, especially on the GC side, to understand how that would look.
Right.
So we're trying to kind of quantify that, but I think we're far enough ahead of it that we should be okay. It will affect future underwriting, for sure.
Well, how's the developments up in the Lakeview side? I know you had that was announced that was sold off. And so I know you've completed that project up in the Lakeview. And then how'd you like developing? I mean, I've driven by it. It's beautiful. Right.
Yeah, that one was good because, we did 3 buildings on Ashland, which some people wouldn't necessarily be in love with, but they were 2 blocks from Roscoe and Southport, which I believe is one of the best neighborhoods in Chicago. Probably my favorite, the Southport corridor. So that was, again, being kind of local. Maybe you wouldn't have seen an industrial building on Ashland and thought, oh, that should be an apartment building, but we kind of understood that. They had good help from the alderman at the time, who's not there anymore, to rezone that stuff, 2 out of the 3 buildings. So those are great. Those are 100% occupied, growing rents, refinanced them. We're going to probably test the market here soon and go to market with those buildings. We sold one of the 3. It's a 6 cap type environment, which I'd much rather sell at a lower cap rate, but who knows what's going on with interest rates. And our rents have kind of negated the increase in interest rates. They've kind of just gone hand in hand. So the pro formas for folks that kind of did these deals 3 or 4 years ago, while we have seen long-term interest rates probably up 250 basis points or whatever it is, interest or rent per square foot's up like 80 cents a foot. It just kind of pushed everything up. And then in the end, your spread I build the cost to sell is kind of the same spread.
Yeah.
I'd rather wait for the cap rates to go down to 5 again.
Yeah.
That could be 5 years from now. I have no idea. Right. So we're going to test the market with those buildings as well as our Lincoln Park building called the Porter. Probably here in the next couple of weeks, take that out the market. Another one I'd love to hold on to, but 4 years in, you kind of want to see what the IRRs are for the investors.
Yeah. I mean, I really thought interest rates, as we sat here, would have been lower by now. I think a lot of people did, but we'll see. Maybe it still could be.
Yeah, it could be. And hopefully the buyers are bullish on that happening and they can put in some short-term debt and make a ton of money later when the rates are down, right? I mean, that's kind of what we're hoping, because when rates are where they are today, you're kind of selling at like a very low cash on cash for the buyer.
Yep.
So they have to believe in the upside, and that's a wait and see. There's a lot of stuff out there that's distressed. Totally different conversation, right? That stuff has to sell. We'll sell if we get the numbers we like, and if not, we'll hold. And we've got 5 years on our debt and try it another year.
Yeah.
It's a good place to be.
It's brand new supply, 100% occupied. Right. The luxury of being patient if you want to.
Right.
But someone's ready to buy now at a good price.
Yeah, it'll be fun to see.
Look amazing in a couple of years.
I hope so.
And how about the Porter? You want to talk about that one? I mean, I love that corner. I always have.
Yeah, that was a really fortunate purchase. Again, kind of a pandemic, almost like a whiff, I think, by a couple other folks that were looking at it, just because everything stopped. And
yeah,
we approached the seller of that off market, well, through a broker, but it was kind of on hold. And again, based on local relationships and knowing what's by right and knowing which zoning attorneys to check your facts on. And we ended up really drawing that whole building per the code in order to really close at a time when we can close on the property and know we can build it and take any, even if there's no zoning risk, there's always some zoning risk. So that was one where we really capitalized on a quiet time, and we spent all of our time on that design. And ultimately we had no pushback from the elder woman at the time. And we built a great building. And then we ended up getting Wells Fargo on the corner. And the zoning for TSL, which is transit served locations, kind of got tweaked while we were building the building. And we realized we could omit some of our parking because we had 1-to-1 parking. We had 36 spots for 36 units and create more retail. And so kind of out of nowhere, or out of $250 a month parking spaces, we got a 2,400 square foot Panera Bread. So that was really creative as well. So even though we're not retail guys, the retail kind of made that as special as it is. And the apartment's $425 a foot. And that tenant base is like straight out of the Big Ten schools. And we actually have in our we have in our marketing package, I've never really seen it, the companies the tenants work for.
Oh.
Just to show like, this isn't like the companies that are in Chicago. This is the companies like on our rent roll.
Yeah.
And it's amazing to see, like, it's like all big names. So it's pretty cool.
That is really cool.
Yeah.
And I'm sure having a place to grab some food is good for them.
Yeah, 100%.
Nice and quick.
Yeah.
Yeah.
Yeah. So great corner. If we can find more of those, we'd be very lucky.
Yeah.
There's not many of
It's
them.
kind of a unicorn.
Yeah.
Just a beautiful piece of land sitting there ready.
Just
right on a main.
Hit it in plain sight. Is that what they say?
Yeah.
Like, everyone knows that corner.
Yeah.
Every developer knows that corner. And we just somehow caught it at that moment in time when seller wanted to sell and no one else wanted to do anything.
You want to say the street names?
Oh, yeah. It's Halstead, Fullerton, and Lincoln. For those Chicagoans that know Lincoln Park, it's the old called the Bum Park.
It's beautiful. It was a park that was just sitting there unused by
anybody.
Yeah. And it's just sitting there ready to be utilized. And now people live in one of the prime streets in Chicago.
Yeah.
They can go any direction, 6 directions, and run into some fun.
Yeah, it's a great spot. We put a pickleball court on the roof, which was one of the first ones in a sort of residential size project. There's pickleball courts on like a post office building, but we kind of proved you can put one on a 16,000 square foot site and still have a huge roof deck.
Yeah.
So that was kind of a cool thing that we've seen that now in a couple other buildings. But yeah, that one turned out really, really well.
So people can blame you for the pickleball craze.
Yeah, luckily we're like at such a busy intersection that the pinging of the ball doesn't really like bother anybody.
Yeah.
It could be a little different if you're in.
Yeah, quiet neighborhood.
Quiet neighborhood, yeah.
Well, are there any neighborhoods that you haven't got into yet that you got your eye on?
I really am learning more and more about Westtown and going all the way west to like Smith Park. There's just a path of progress there you can see happening. And with United Center stuff being south of that.
Right.
So that's going to be a 10-year project to even see like really it come to some sort of fruition. But they're going to start, I think, sooner than most think. And so I think that whole Western corridor, west of Fulton gets pretty industrial over there, but obviously that's starting to turn already. I live off the Western and Hubbard train line. Everyone thinks about the metro. When you sit in the traffic, we have to sit in to get here.
Right.
So we've been poking around kind of Western and Hubbard for like a building to buy and maybe turn it into an office or something like that. So yeah, I kind of like that Western corridor. Going north, I feel like it's been looked at by everyone for years and years. We've kind of historically stayed south of Irving, but I think Lincoln Square, Andersonville, any of those Broadway and Clark corridors, anything close to the lake, all that can work now for new construction. So
all great areas.
Mm-hmm.
Any other challenges that you've seen that
there's always other challenges. The union stuff is tricky when you get into this kind of world we're into now. Generally, the neighborhood's like 50 units and under. you'll get a little bit of union interest, which means union activity on your site.
Yeah.
Units is right at the cusp. We are all union currently, so we're in pretty good shape, but there's some other developers in our world having some issues with unions that are not using unions. So everyone knows that that's an issue here. And it's not really an issue when you can, the big towers is fantastic.
Right.
Because you can't go to another city and have 8 contractors that can build residential towers. Like, there's just not. It's not that deep. Maybe Dallas and a couple other markets, but Atlanta. Anyway, so that's something that we have to just kind of think about as we get a little bit bigger. We don't think about it as much in the neighborhoods and the small stuff. But yeah, I know that's really it. I think working with good aldermen and neighborhood groups, if you're on the quieter streets, can be a big pain. But generally, we've been on Ashland, Lincoln, Grand, busy thoroughfares. I've seen folks do smaller deals on more interior streets, and NIMBYism can get pretty real pretty quick. But the bigger streets, I think we kind of have a case that, like, we need housing. This is where it's got to go.
Yeah.
So nothing else that I can think of.
Before I let you go, let's talk about your advisory arm. I know you provide advisory services to third parties. I can see that being a big market for you. We've talked mostly about your own projects that you're the lead developer on, but how's that going? And are people starting to get you ready to give advice for the future?
Yeah, it's interesting. When I put that on the website 5 years ago, I was thinking almost more of not a brokerage arm, but almost more of someone to help someone transact. I do have a sponsoring broker in Illinois. Haven't used it for a transaction in probably a decade, but I keep the CE up and I keep the license. What it kind of evolved to was more of helping larger developers get into Chicago or out of Chicago. And so all these deals take a long time. We have done 6 different deals with large scale developers. Some have closed, some have not, where we've either been like a small GP partner or a fee developer. We've done also some entitlements in Dallas for a fee. So, it can really take different forms, I guess. But what we found is that especially folks trying to get into Chicago from maybe Texas or Florida or California or New York or wherever that don't understand the local landscape, we can be very helpful. And because we're such a small firm, we can just be nimble. The way to do bigger deals, but not have to put it all together and raise all the money and take all the risk. So it's been good. It's a very small piece of the business. And a lot of that's because there's been no institutional activity here. For a couple of years. 2-3 years ago, like I said, we had, I think in 1 year, we had 6 deals under contract with partners 1 year. So we know we can do those deals. It's just the folks from out of state have to want to be here. We're not less so trying to do some out of state. I like to kind of pitch it as, if you want to work in Chicago, like we can hopefully be helpful.
Come talk to Matt. He'll tell you which streets are good streets and where to build.
Then I'll tell him to come talk to you.
Yeah.
Hopefully.
That's how it'll work.
Yeah.
Anything else before I let you out?
No, this has been great. I enjoy your podcast. I listen to them, and hopefully this one gets some attention. And
I'm excited to get it back up and running. So I've been a little quiet the past few months. I moved firms over to McGuireWoods, national platform. Super excited to be here. And so I had to first make sure all the clients were coming, take care of my day job, make sure everything was going to work. Everybody was set up and functioning before I could get back to the podcast. So you're my first one here under the new roof. Glad to have a recurring guest and look forward to doing many more podcasts. So you're always welcome to come back.
Thank you very much. I look forward to it.
Thank you for joining us on this episode of Real Estate for Breakfast. To learn more about today's discussion, please email host Phil Coover at pcoover@mcguirewoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this series, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.